Hello. Thank you for your interest in our continued coverage of PetroQuest Energy via the Birken Road Reports program. My name is Kate Kirsting, and my fellow analysts, Alexander Sheena, Fred Chasten, William Gates, and I will be sharing our thoughts with you on PetroQuest, starting with our 12-month target price and investment rating. We've assigned PetroQuest a target price of 85 cents and a market outperform rating. Today we're going to go over a brief description of the company, our investment thesis, valuation, our site visit, an analysis of the company's industry and peers, a general overview of risks the company faces, and a summary. PetroQuest is a small, independent oil and gas exploration and production company headquartered in Lafayette, Louisiana. The company drills for and produces oil, gas, and natural gas liquids, NGLs, in areas across the southern region of the U.S., including Arcoma, Arkansas, East Texas, and the Gulf of Mexico. Beginning in 2003, PetroQuest formulated a new strategy to diversify its reserves by focusing on longer life and lower risk onshore properties in the Woodford and East Texas Basin, using cash flows yielded from previous operations in the Gulf Coast Basin. Since implementing its new growth strategy in 2003, PetroQuest has grown production by 348% and estimated proven reserves by 377% as of 2014. Our ratings regarding PetroQuest were based on the following factors, around which we built our investment thesis. One attempt by PetroQuest to offset its steep decline has come from increased investment in its Cotton Valley production fields. Cotton Valley is PetroQuest's best performing area, and in the past year, production in Cotton Valley has increased 67%. This level of growth in production is noteworthy in a time during which many small independent producers have been forced to slow or cease production due to low oil prices. In order to fund the investment in Cotton Valley and other potential future investments, PetroQuest sold off its Arcoma Basin asset in June 2015. The divestiture left PetroQuest with a significant increase in available cash and, just as importantly, allowed the company to repay all of its borrowings under credit facility. The Gulf Coast has historically been an excellent source of cash flow for the company, and while Cotton Valley is currently its best performing asset, PetroQuest is continuing to rely on the Gulf Coast for cash flow. As of 2014, the company was earning $40 million of free cash flow from the Gulf Coast. Should this level of free cash flow continue, the Gulf Coast will continue to be a viable production asset for PetroQuest. Despite the benefits of increasing investment in Cotton Valley and the Arcoma divestiture, the unprecedented slump in oil prices in the past 1.5 years may mean very slow growth for PetroQuest in the coming few years. The uncertainty facing the oil markets as a whole has turned many investors away, and though PetroQuest produces majority gas, the company's stock price will likely reflect the negative oil market sentiment for the foreseeable future. Though PetroQuest produces 75% gas, oil prices continue to affect the overall stock price and well-being of the company. The company faces headwinds because when oil is doing well, PetroQuest is written off as mainly a gas producer. But when oil is doing poorly, PetroQuest is an energy producer and the stock price reflects the overall market sentiment. Our report attempts to examine PetroQuest as an energy company surviving the downturn in oil prices and recognizes that both oil and gas will affect the overall well-being of the company. Our team used an E&P PV10 valuation to determine a 12-month target price for PetroQuest Energy of 85 cents. The PV10 valuation method yields a present value of projected future oil and gas revenues, net of direct expense estimates, and discounted at an annual rate of 10%. With this 12-month target price of 85 cents, we give PetroQuest a market outperform rating, as that would represent a 46.6% increase from the current share price of 58 cents on April 4, 2016. On Friday, March 4, 2016, our team of analysts traveled to PetroQuest headquarters in Lafayette, Louisiana for our site visit. We met with Matt Quantz, the company's corporate communication manager. Regarding the balance sheet, Mr. Quantz seemed very confident that the company will recover from this commodity market downturn and make it through to year-end 2017 if prices stay where they are. The main strengthening of the balance sheet has come from the sale of the Oklahoma assets in June 2015, which provided enough cash for the company to repay all bank borrowings. The energy industry can be described as follows. The trends and drivers in the industry are almost always connected with supply, whether that's oversupply or undersupply, as well as global demand for oil, gas, and NGLs. The industry is heavily regulated at the federal, state, and environmental level. Barriers to entry involve the intensive capital investments required up front. Suppliers and producers of oil and gas have much more bargaining power when it comes to price than do buyers, and small-scale exploration and production companies like PetroQuest have little influence on price. Though there are some available substitutes for oil and gas, like nuclear and other renewables, none will soon be market leaders the way oil and gas are. Lastly, despite the high barriers to entry, the exploration and production industry remains extremely competitive. Many of PetroQuest's competitors are similar to the company in operations and location, such as Anadarko Petroleum Corporation, Memorial Resources Development, BHP Billiton, and Stone Energy Corporation. The company, in its most recent investor presentation, referred to the first three as close competitors in Cotton Valley, a field in which the company is investing heavily. PetroQuest faces a certain level of risk related to the natural environment, as exploration and production depends on access to fields, rigs, and other equipment. Poor or dangerous weather can restrict this access and destroy property. As an oil and gas producer, PetroQuest faces the risk of commodity price volatility. Without access to capital, PetroQuest and other companies like it eventually have to cease operations. Formal actions like the 6-month deepwater drilling moratorium enacted after the Deepwater Horizon spill are regulatory risks all exploration and production companies face. Financial risks include investment risk, credit risk, and business risk. Liquidity ratios are excellent measures of risk for a company. The current, quick, and cash ratio help demonstrate the risk that an investment may not be easily traded or sold for cash. In summary, we give PetroQuest Energy a rating of market outperform with a 12-month target price of 85 cents. Thank you.